Meantime, major averages pulling back this morning, as we mentioned, still just a few percentage points from those record highs. Our next guest calls the markets push higher from the lows, quote, the most hated rally. Tom Lee joins us, Fundstrat Global Advisors, head of research and CIO, joins us here at Post 9. Tom, it's great to have you back.
Yeah, great to see you all.
Why do you think it's been so hated? Because April was so sort of near death?
Yeah, I think it's hated because not only was it near death, but it was a dire economic scenario that in people's minds is still unresolved, and yet the markets have rebounded the entire decline and actually now approaching all-time highs. So it's been too fast, and I think a lot of people liquidated and then never got back in.
Which part was too fast? The rally or the April lows?
Both. It was a waterfall decline.
Yeah.
And we look back since 1900, of the 12 waterfall declines previously, almost all are V-shaped bounces, except for 2022. So I think it aligns with history. But even on my way here, someone stopped me and said that they're just a person who watches CNBC says they're still bearish. They don't understand why markets have rebounded. I think the majority of people are bearish.
People stop you on the street to tell you that they're still bearish?
And then what do you say when they say they're still bearish? Do you
say bye, right?
Yeah, what do you tell this person?
Well,
you probably love that.
This person watches CNBC because he was telling me that he's like...
Many people watch CNBC, Tom. Many, yes.
Yes.
We get stopped all the time.
Yes.
But what did you say in response to I'm still bearish?
Well, they said PEs are too high, and I said, but the 10-year can come down because Powell thinks there's inflation risk premia in the 10-year yield. And if that comes down, then PEs aren't expensive.
So I do wonder, with that as your bull view, that rates can come down. So I mentioned the weaker jobless claims today and how that's sort of creeping up. I've sort of been sprinkling in some weakness in the jobs market. Do you think that the stock market will be able to withstand that if we really start to see weakness in jobs because it means Powell's going to be closer to cutting?
Yeah, it's a good question. Joe Weisenthal called it like a slow leak in the economy, and I think it's accurate because there has been this shock. We know that like in the beige book, port volumes took a hit, trucking took a hit, but is that just a blip or is that the start of a downturn? And I think the markets are going to be able to suss it out eventually. But, I mean, so many stocks are acting well and the guidance has been better that I think it feels more like a blip.
You now have the Granny Shots ETF, GRNY.
Yes.
This was a sort of a framework that you devised a couple of years ago, right?
Yeah, 7 years running. It was originally a core research portfolio called Granny Shots, and now it's the ETF.
So what's the construction of it these days?
It's 34 names, still concentrated, and it's focused on the themes like AI, cybersecurity, automation, monetary policy easing. We're glad it survived the Black Swan event this year because
it filled that gap. Yep.
Yes, yeah, and outperforming this year by 500 basis points. So it's a good year for Granny Shots. But I think it's a reminder that we try to get investors focused on long-term themes. Like AI doesn't really care about tariffs long-term, and cybersecurity doesn't care about tariffs. And so these are the names that, as you get through that, as that noise lifts, the stock should recover.
Have you been unnerved by any of the macro data that suggests maybe data center construction, manufacturing that second derivative is slowing a bit?
Well, the second derivative should eventually slow. But the need for AI and the innovation that's coming really is driving a lot of innovation. And when there's innovation, that's where economic value add comes in. So I think so much of global GDP the next 10 years is coming from AI and cybersecurity and